Welcome to the Planet MicroCap Showcase Vancouver 2024 in association with Small Cap Discoveries. I'm your host, Robert Kraft. I'm very excited to introduce this virtual keynote presentation for our event. Joining us for this keynote is Erik Nelson. He is the president at Coral Capital Advisors. He has a very fascinating presentation on cross-border trading and listing versus settlement, as you can see here. So with that, Erik, the floor is yours.
Bobby, thanks for the introduction. As Bobby had previously indicated, I'm going to be talking about cross-border trading and listing versus settlement, understanding the key elements of the process for helping a liquid and active market develop in your company's securities. This is Coral Capital Advisors. We've been around since 1995. You can see a list of some of the services we provide to our clients. We're out there actively servicing public and private companies as well as other participants in the capital markets. What we're going to be talking about today is cross-border trading. And for the purposes of this discussion, that is going to primarily concern shares of companies that are listed in Canada, because we are in Canada, and having their shares trade in the United States. You know, there's several benefits from a listing in the United States. You have greater exposure. The population of the United States is approximately 330 million people versus slightly more than 30-some million for Canada. You have approximately 10 times the number of potential investors in the United States who would be interested in your company's securities as opposed to there are in Canada. This is significant. This can lead to a higher valuation. After all, price is primarily a function of supply and demand. And if the supply of your company's shares is relatively constant or only increases slightly, but demand goes up, you'll see a higher price in your shares. I mean, that will result in a higher valuation, and that is something that company management should very much appreciate, particularly if you're looking at raising capital or growing your business. So, in terms of the size of the U.S. market, I've got a little chart here, but basically, if you look at it, the New York Stock Exchange and the NASDAQ together have combined market capitalizations of almost 47 trillion US dollars. That means that the value of the companies listed on those two exchanges is about 47 trillion. The next 13 largest stock exchanges barely exceed the $47 trillion market capitalization. That's significant because the U.S. has the largest, deepest, and most well-developed capital markets in the world. And if you're looking at raising money or increasing the valuation of your company, this is the place to be. So for trading in the United States, a company basically has two basic options. You can list on a national stock exchange, and you have the New York Stock Exchange with its higher listing standards. You have the Amex Venture Exchange for smaller companies, and the NASDAQ has the same with their national market system and their small cap market. The alternative to these national stock exchanges is the U.S. over-the-counter market, which is not a stock exchange. And this is significant because stock exchanges have rather strict listing requirements. And one of the most important ones is the disclosure requirements. And as a company listed on a national stock exchange, you either have to file as a domestic U.S. filer, filing 10Ks and 10Qs and other reports, providing proper disclosure to your clients, or as a foreign filer, you have to file reports according to the F company standard. And this is a lot of 6Fs, 20Fs, and other reports. And this can cost a significant amount of money, depending upon the legal requirements and the audit requirements. Fortunately, for shares that trade on the over-the-counter market, the SEC has an exemption for foreign companies. It's based upon Rule 12G32, which basically says that a company whose shares trade on a qualified foreign stock exchange do not need to file reports directly with the SEC. And this is important. They are allowed to use the filings they submit to the regulator in their home market for disclosure here in the United States. So for companies in Canada, they are allowed to use the filings they're submitting through the CEDAR system for disclosure in the United States. This dramatically reduces the cost of filing or being a publicly traded company here in the United States. So when a company's shares trade on the over-the-counter market. They're trading by definition off exchange. And I just want to take a minute to look at this. They're trading on what's known as an alternative trading system, which is like an exchange light. And the quotes we're seeing are provided by an interdealer quotation system, such as OTC markets. There's a common belief that OTC markets runs the over-the-counter market, but it does not. It just provides a lot of information on and provides a method of executing trades. So there are two basic methods that a company becomes traded here on the over-the-counter market. The first is they file a 15C211 disclosure statement with either FINRA through a broker-dealer or via OTC markets, and they get it approved. The alternative to this method is a trade is run. So basically you have a company whose securities are not traded or quoted. Somebody buys shares in that company, and as part of settling the trade or reporting the trade, FINRA assigns a ticker symbol. Both methods will provide a company with a ticker symbol for trading on the over-the-counter markets. However, neither one alone will provide DTC eligibility, which is an important component for developing a liquid market, and we're going to talk about that later. And also, they differ in their blue sky approval, or their what's known as trade suitability. And here in the United States, the different states have regulations as to what makes a security eligible for trading or purchased by investors that live in their state. This is known as blue sky. And if you have unsolicited quotes only or do not have an effective 15C211, you may not be a blue skied or allowed for purchase in a lot of states. And if you're attempting to develop a market for your company's securities here in the US, this is absolutely crucial, because most broker dealers will not allow the trading or the purchase of unsolicited quotes only, or not companies without an effective 15C211. They won't allow the purchase of those securities by their clients. I get asked this all the time when I go to investor meetings here in Atlanta, whether the shares can even be bought by the people that are sitting at the tables with me. So I want to take a look at this a little bit further. One of the things I want to talk about is what is a 15C211 disclosure statement. It takes its name from the rule, which with the same name, that details a list of information that needs to be provided. It's a disclosure document that basically says we have adequate information for investors to buy and sell our shares. Rule 12G3, as I previously mentioned, exempts foreign companies from a big part of this disclosure requirement. They're able to rely on their domestic filings, their home country filings, to satisfy this requirement. What that allows is for foreign filers here in the United States to file an abbreviated short form 15C211 and receive accelerated approval. And it can be dramatically quicker for a foreign company to receive approval on a 15C211 filing than it would, say, for a US domestic company. And that's because their shares have already been approved for a foreign exchange. So shares that are, for example, trading on the Vancouver Stock Exchange or the Vancouver market or even the Canadian Stock Exchange are deemed to have already passed the regulatory requirements for trading on those exchanges. So the SEC kind of says if you're already satisfied those exchanges requirements, we're not going to look as hard at you here in the United States. The other thing to remember is a 15C211 disclosure document or package can only be submitted by an interdealer quotation service such as OTC markets, or a broker dealer that makes a market in those companies or makes a market. So not every broker dealer makes markets, so it's important to know which ones do make markets that you can work with to get this taken care of if you need a 211. The other item I'd like to take a look at is when a trade is executed, what does that mean exactly for your securities? It means an investor bought or sold the securities, most likely an institutional investor, because for someone to execute a trade in an unlisted, non-traded equity, it takes a lot of work, and it also takes a very sophisticated account. So that means there's an extremely small chance that this was a retail investor. But this is also very positive, I believe, because when I've been in the room and I've talked to people where this has happened with their company, what it ultimately means is there's a pretty sizable institution that has done its homework on your firm and decided it wants to own it. And this is a big deal because from their standpoint, they have put some money into an illiquid security that they expect to hold for a long time while they're waiting for a liquid and active market to develop. And when this happens, OTC markets will designate your company as unsolicited quotes only, meaning it needs a 15C211. And it will also, by default, need DTC eligibility. And you're probably going to ask yourself, how will I know? Well, it's simple. You go to OTC markets, you punch in your ticker symbol, and you go to the quote, and you're going to see this. Warning, the security is eligible for unsolicited quotes only, and it'll tell you down at the bottom, you need a 211. What that means is a market maker is only able to publish quotes for actual orders. And that can mean that your price of your quotes are all over the place. You can have a $2 stock one day and a 10-cent stock the next day. It's not good for attracting investor interest. And when that does happen, a lot of times you're going to see something that looks like this. This is a level 2 screenshot of a company that is unsolicited quotes only and actually needs DTC eligibility as well. And as you can see, the stock is quoted at $1.30 bid and a $6 offer. As there's an old saying in the market, that's a spread you could drive a truck through. And typically they'd be referring to like a Mack truck, not a pickup. So with a $4.70 spread on this company's stock, you can see why there's not a lot, why it doesn't trade a lot. It also trades what we kind of say trades by appointment. You might have trading one day and then no trade for several weeks at a time. That's not good for attracting investor interest. So there becomes a solution to this. You have a 15C211 filed, you become what is known as proprietary quote eligible. And that means that the market makers can submit bid and offer quotes for their own account. What they're attempting to do is they're attempting to engage in price discovery, which means they're looking to find a price where sellers are willing to sell and investors are willing to buy and pick up the stock. Their goal is to help create a liquid and active market so they can profit from the trading volume. This also helps reduce the stock price volatility in your company shares because you're not dependent upon the whims of a couple investors who may want to buy one day and then not be there the next. The next thing is, this is what a market, a level 2 market will look like if you're proprietary quote eligible and have DTC eligibility. This is a Canadian company. I don't remember the name of it, but you can see it's got a foreign stock designation by the F on the end of its ticker symbol. You can see a list of the market makers, and on the right, you can see the trading activity that occurred the day before. I picked this up early in the morning, so it didn't capture full day's trading on the 18th. You can also see that this has a much narrower spread. The bids are just over 9 cents, and the offers are just over 10 cents, with less than a penny difference in between. That's a positive thing. This is a sign of a liquid and active market developing for this company's securities, something that every company officer and director and investor wants to see happen. The next thing I would like to take a look at is I previously talked about DTC eligibility. And what DTC eligibility means is that DTC has approved your shares for deposit into DTC. They're now settlement eligible. That means that they can be electronically settled among the clearing firms at DTC. And what this means is the broker dealers, the clearing firms, no longer have to settle trades by shipping physical securities back and forth to transfer agents. It greatly reduces the cost and the time for settling trades on company securities. And I can tell you, because I also own a transfer agent, sometimes on some of the securities that are not DTC eligible, where they're doing physical trade settlement, the cost of settlement can actually be far greater than the cost of the trade. You might find someone bought $500 worth of stock and they incurred almost $1,000 to settle the trade. That results in a lot of unhappy shareholders. And it's also important to know most broker dealers in this country will not allow their clients to execute trades in companies that are not DTC eligible. While we process trades settle trades, move the certificates around for a few companies that are not DTC eligible. I can honestly tell you that those certificates come from one of 3 or 4 clearing firms in the country. There's over 100 and some self-clearing broker-dealers in the United States, and there's less than a half dozen that are settling these trades on a regular basis. So if you have non-DTC eligible securities, virtually no one's going to be able to buy your company's common stock or securities. So there are, and it's important to understand what this looks like. So I pulled a screenshot from DTC on a company that I know is DTC eligible. You can see where it says it's eligible for direct registration and the FAST system, and that it's CNS eligible. That means it's fully DTC eligible. And in addition to being eligible for electronic trade settlement, this one also allows for book entry delivery of shares in and out of DTC. The alternative to being DTC eligible is custody only, or in a worst case scenario, DTC just doesn't know your company exists. So when you're custody only, which is where most companies that are not DTC eligible find themselves, DTC will hold shares in your company's name. They're registered in the name of the clearing firm and held in the vault. But this is where things change. The trades are settled physically. And what that means is when a trade occurs, DTC will send certificates to the transfer agent to be re-registered. So 5 certificates might go out and 10 might come back. And then they'll take 7 of those 10, ship them back and to the transfer agent and say, register these in the name of the clearing firm where the buyer was. That's a lot of movement and a lot of expense to settle a trade that could be settled electronically. And this is how the costs go up. You have certificate cancellation fees, and you have certificate issuance fees, and you have book entry fees. And then the broker-dealers tack their fees on top of that. And it's cumbersome. And this is why most broker-dealers just don't want to deal with this. So what we're ultimately trying to do, everybody here, everybody at the conference, and everybody who invests in the over-the-counter market, we want to have a liquid and active market, one that allows investors to buy and sell securities as they see fit. And that's a good goal to have. It's a measure of success as a corporation, that your shares are liquid, you have an active market. And what I'm focused on and what I tried to cover here in my presentation today is that it is the job, it is a goal to create the environment to allow for this to happen, to make it so that when an investor hears your presentation and says, I like this company, I would like to own stock in this company, they can do it. That they can log onto their account, they can enter the ticker symbol, decide how many shares they want to buy, and they can purchase those shares. That is the goal. If a potential investor can't buy your shares, you wasted your time and your money presenting to them. If the potential investor looks at a quote on a company's shares and they see a very wide spread between the bid and the offer, they're not going to want to buy it, because they decide if they need to move or sell the stock, they're going to take a hit just on the size of the spread. Or they worry that if the offer goes up, the bid won't follow. So by closing that gap on the bid and the offer, you increase the chances that an investor is willing to buy. You don't guarantee they will, but you create the environment where they're much more willing to acquire something. And the key components of this are, you need an approved 15C211. It allows the proprietary quotes. It allows the market makers to help create liquidity in your shares. That's what they're there for. And the DTC eligibility, allowing for the electronic settlement. It reduces transaction costs, and it opens up the vast majority of broker-dealers to being willing to allow their clients to buy and sell your securities. So I've covered a lot here on this, and for a lot of people, they normally don't see this in their day-to-day activities, because after all, it's the job of management to principally run the business and manage the operations. So we've got a couple of solutions here. You want to identify your company's status. Do you have an effective 15C211? Are my shares DTC eligible? And so for the companies that are presenting at the conference, prior to the conference, I went through and I looked at every company's securities on our DTC terminal, and I printed out a screenshot showing whether your shares are eligible or not. I also went through and looked on OTC markets to see who had an effective 15C211 or who did not. And we have a package for you if you'd like to stop by our table and pick it up. I'd be more than happy to discuss it with you. And if for most companies, about half the companies here, we feel that they have an effective 211 and that their shares are eligible. But if not, it's real simple. We can help submit, or one of the other firms here can help submit a 15C211 on your firm's behalf. And if you need some assistance with the paperwork, we can help you with that. And we can help get your shares DTC eligible. And it's simple, it's easy, it's not hard. It's money well spent if you're out there pitching investors and you're trying to grow your business and trying to raise capital or increase awareness. And for people that are viewing our presentation, if you're looking at this online, however long after the conference, and you'd like to talk to us or get some additional information, here's my contact information. We're Coral Capital Advisors. Here's our websites that cover our services and what we do. This is our address in Atlanta, Georgia. And here's my direct office number as well as my email address. So I look forward to hearing from you and answering any questions that you may have, and being of assistance however possible.
Well, Erik, with that, thank you so much for your presentation here today. We really do appreciate it. Good luck, stay safe, and we look forward to the next update.